Welcome to the March 22nd, 2021 Advance Report from McGowan Group clients and NetWorthRadio.com listeners. I'm Spencer McGowan, your financial weatherman with the fast-paced tour of the global financial markets. I'm president of McGowan Group Asset Management based at the Crescent in Dallas. You can come down and see us with safe operations, and you can set a Zoom meeting anytime. And we like to see you. For the extended version of the program, go to networthradio.com, and the extended audio version is at Apple Podcasts. Now, thank you for tuning in to YouTube McGowan Group. We will start right here. There were huge money flows this week. Two parts to it. What the Federal Reserve told us, some of which is good, some of which had big impact on the interest rate markets and others. Now, the other headline came out Thursday afternoon at about 2 o'clock Dallas time. It sent oil from 65 to 58 briefly, closing the week back above 60. What was the headline? It was the French shutdown for a month. So we were all worried about inflation, and then all of a sudden we get another shutdown in France. The question being market impact this week, plus what it really means going forward. Let's take a look at the big picture on money flows. This is the T-bill. For the first time in history, the interest rate on a 90-day Treasury bill is negative. That means money markets will start to go negative unless their sponsor supplements. Welcome to paying somebody for holding your cash. Hasn't happened yet in the U.S. banking system, but the first money markets to go negative will be institutional. So if you happen to be a CFO in charge of the Treasury operations, keep that in mind. Check the money market yields, because it could be the first time that they charge you for being in that money market or holding cash. Other countries, that's happened already. In Europe, minus 0.03. The Fed said we're going to keep the short rates low. We're going to print lots of money, 80 to 150 billion a month. They're going to go to about 8 trillion in money supply from 4 trillion. We know that's bad for inflation eventually. And because you double the amount of dollars in circulation representing the same stuff, then you got a value of about half as much if we do the math. That way, interest rates on the long treasuries went up. I'm going to show you the impact on price, because most fixed income allocations that are traditional are not the right place to be this year, and I'm going to cover a good choice on fixed income in our opinion later in the sequence. But you've seen the interest rate on the 30-year Treasury go from 1.65 to about 2.5. The 10-year went from actually a low in the pandemic, it got as low as a half, that's 0.9. This is 1.75, 1.75%. But the T-bills went the opposite direction. That's called steepening on the yield curve. What are some of the impacts of what the Fed said? Well, I want to go to their forward projections. This says GDP growth estimates were raised for 2022, and they said it could be as high as 6.5% in the recovery year, obviously because last year was negative, the shutdown quarter was a -9. And so we look at the way they measure the GDP, minus 31, if you annualize that -9, 33%. And then we see 6.5 coming out here in 2021 as the peak, because you're going to compare to those low quarters. But what does it mean going forward? We'll return back to about a 3% GDP in 22, according to the Bloomberg economists and the Fed itself. It says eventually we go back to 2% or below. Deregulation and taxes will probably result in something closer to 1% GDP if those trends continue. What's the impact on a Treasury bond or a long investment grade bond when interest rates rise? Boom, you can see it here. If you had a long-term government securities fund at the start of the year, it's down about 15%. This is the price of a 20-year Treasury ETF. That's bad. The big part of fixed income in the Vanguard total bond market is negative year to date, has a decline in value of about 4% with a yield of only about 2. And so when you look at something like this, where the yield was about 2% and now the price goes down by 15, that means a lot of fixed income portfolios are just the wrong kind of fixed income. Cash or high yield at this point would have been better because those returns are either zero or a slightly positive for the high yield, and I'll get to that in a second. Okay, look at this. This is oil, right? Big uptrend, went almost to $68. France said they're going to shut down, and inventories in the U.S. actually expanded for the week, and that started a decline, but boom, instantly to 58. Does that mean this oil trend is over? Actually, what it means is demand is catching up pretty quickly with supply. Gasoline demand is way ahead of what was forecast in terms of full recovery, and can production keep pace? That's what the $68 was about. But it also means the pipelines are filling back up, and they get paid for flow. Every barrel of oil, every million BTUs natural gas, and the jet fuel being restored, the airlines being restored. That is a great inflation-friendly sector, in our opinion, the energy infrastructure. And this indicates that demand is in the process of restoration. The French shutdown probably just a blip in terms of forward thinking in demand versus supply. Now, what's the number one performing sector in the S&P so far this year? Well, it's energy, closing the week at about a 30% gain. Pipeline total return was about 25% so far this year in its recovery from last year. This other sector is financials, this purple right here. That's about a 15% overall return for the year. The bank's coming back nicely. Texas Capital Bank, congratulations. I'll show that chart in just a second. This is the technology index. So technology appears to have peaked. It's actually the FANGs, Facebook, Amazon, Apple, Netflix, Google, and others. So the high was about a 16% return, the low is a -3, now finishing the week at about a 3%. So technology no longer leading the market is what this tells us. A lot of those got overpriced. This is the pipeline index showing a total return so far this year at about 25%. This is the high yield, one of our high yield choices, and not a recommendation for your portfolio until you come down and get a plan, because where it fits or if it fits is part of where you want to get to. But in this case, total return year to date, about 8% so far, which is a standout in the fixed income choices compared to what happened in most of the traditional index-based allocations. Now, this is Bitcoin. We cover in the program, there are 6,700 cryptocurrencies now. About $1 trillion is in Bitcoin itself, and it hit 62,000, now about 58,000. Everybody's interested. There's a dispersion across 6,700 different choices. Number 1,600 is called rotten, by the way. There's only about $750,000 in rotten. Obviously not a recommendation, but the point being, money is being dispersed into lots of speculative technology companies, lots of speculative cryptocurrencies, and that usually doesn't end well, but about $2 trillion has gone into crypto so far. Texas Capital Bank, just a final wrap up here. They are not at an all-time high, but they've had a year that has taken Texas Capital to about a 45% gain. The bank's coming back. The fear that there would be mass defaults in energy was the reason that it started the year so inexpensive. Congratulations to Texas Capital, Dallas-based Comerica, San Antonio Frost. Texas Bank's actually leading the bank index, which is good news. Thank you for tuning in to YouTube McGowan Group. We'll be back next week. Be sure to subscribe. If there's fast breaking news in the market, you'll get a special update. And be sure to share with your friends that say, what do you do for great insights in the financial markets? Thank you for tuning in to our YouTube channel. I'm Spencer McGowan, President McGowan Group, your financial weatherman. We sponsor each week networthradio.com broadcast that has the charts and graphs, many of which you saw today. We also sponsor this YouTube channel. Be sure to subscribe for fast breaking news, an alert when we post something in a market condition that may have changed. Our goal is to help you as an investor make the right decisions at the right time. And that's part of what this YouTube channel is about, as well as networthradio.com. I am well served with a team of 10 people, including myself. And that team that cares is actually made up of people who devoted to your net profits and your success, as well as excellence in service. If you want an educational experience to follow this up, get to networthradio.com, themcgowangroup.com. Right here, we disclose our net client experience all the way back to 2001. What that includes, the bear market cycles of 02, 08, 2018, and the recoveries through the most recent quarter. That is true education of investors, and exactly how our clients have done, disclosed right here. Further disclosures: value at risk of loss. Yes, investments are going to fluctuate. That's part of the reason for this broadcast, and that can actually work to your advantage. We'll build that into your plan. So I urge you to go to networthradio.com, fill out the preliminary client questionnaire, a free 1-hour brainstorming session by phone or at the Crescent in Dallas, and we will map out a multi-year plan for you and your family that's appropriate. Just because we talk about a security on this broadcast, or any securities, doesn't make it a recommendation for your portfolio until you have that written plan. Thank you for tuning in today, and we'll be back next week as your financial weatherman.